Lyn Alden, founder of Lyn Alden Investment Strategy, compares the valuation metrics of gold, cryptocurrencies, and equities and evaluates which of these, in her opinion, has never been more expensive. She advises that one thing to keep in mind is no matter what the situation is, we have a tendency to fight the last battle. So, say we lost a sports game, we focus on whatever mistake we did. That's we are focusing on worrying about happening again. Same thing when we have a recession. People always assume that the next recession is going to be like the past recession. So what happened in the past recession, the 2008 to 9 crisis? Central bank assets were a very small percentage of GDP prior to them and banks were highly leveraged. So what happened was when the private sector debt bubble blew up, so real estate values went down. All these banks were highly leveraged, they had very little cash reserves. So they pretty much went insolvent. The Federal Reserve and the Treasury came in and said, okay, we are gonna buy some of these toxic assets from you. We are also gonna buy some of the treasuries from you. Basically, we are gonna create new base money or tokens. We gave them to the banks and it took some of their asset in return. So the Fed, they took something in return for those assets. Some of those things were worth money like treasuries and mortgage-backed securities. Other things ended up being toxic and then kind of physically filtered through and removed from the private sector. So however, that didn't get out into the broad money supply that maintained to state in the banking system to recapitalize the banks and to help them be more solvent essentially. So broad money supply didn't really do much at all from that 2008 to 15 period where they were increasing those bank reserves for that first leg up. It's because if you were a homeowner and you lost your job and you couldn't pay your mortgage, you lost your house, you didn't get bailed out. There were minor physical programs like cash for clunkers or things like that. There were around the margins. There were these physical stabilizers, but there was not some sort of big kind of public bailout. It was mainly to shore up the financial system, and so some people got bailed out. Most people didn't. Most people on mainstream did not. So we didn't have that big increase in broad money supply. So bank reserves are things that the banks hold it with the Fed. It's an asset for the bank, but it's a liability for the Fed. When we have money supply, we store. If you store it at the bank, that's the bank's liability in our asset. And so that's the part of broad money. So what made this 2020 to 21 period somewhat different then is that broad money supply actually did go up quite a bit. And that's because unlike 2008 to 9, all the way up through the years after period, this time they actually did send a lot of money to people. They sent people stimulus checks. If you lost a job and you were not getting your income, they would send you 400 a week in extra federal unemployment benefits on top of the state benefits. So some people got literally thousands and thousands of dollars of stimulus. Then you had the PPP loans that mostly turned into grants. So basically small business loans that were then forgiven in large part. Then you had corporate grants. They were not loaned to the most part, they were given. So what that did was that actually increased the broad money supply. Because what the way that the mechanism there works is the treasury send people money out. They are like you get a car, everybody gets a car, then they issue bonds to pay for that. But then instead of the private sector buying those bonds and that draining cash from the system, the Federal Reserve creates new base money and buy those bonds. So the way that it gets into the broad money supply and out of the Chuck E. Cheese area is that physical component where they literally send you the check. So that's kind of how the 2021 period has been somewhat different than that other period and why broad money supply has gone up very quickly. Now there are still some issues like for most of the past year people had limits on how much they could spend that money. So people were mostly skipping their vacations. They were driving less and they were mostly staying at home, basically being far more efficient with how they did things and they invested in that in like a second Netflix subscription or they bought Disney Plus or something rather than go on like a trip to Europe or traveling around. We are not the more inflationary sort, so energy prices were low, all sort of things were low. The concern to look out for now is that people's bank accounts are largely stuffed with cash and things are opening up. We are heading into the summer, we have these base effects. So now we are in the period where some of that inflation might actually start to be more apparent. If you go all the way back in the United States to the 1940s, in 20s and 30s when they had that big crash in 1929, then they went into the Great Depression, banks failed. There was no FDIC insurance. So if your bank failed and you were a depositor, you lost your money. Because of that, we had this big debt bubble collapse. Lynette adds up that because of that, we had this big debt bubble collapse. About a third of banks just went out of business and about a third of the broad money supply just disappeared. So people literally had checking accounts and then those just vanished. They said we are insolvent. Now we can only pay half the deposit back, and of course that was deflationary. People have less money. It pushed down the prices of a lot of goods, and then only years later, as you got into the early to mid 30s, they started to do things to kind of unwind that deflationary spiral, where they devalued the dollar versus gold, which helped some banks stabilize because they had gold as reserves. They basically did a bunch of things to kind of recapitalize the banking system, and they started to get that inflationary move out of that deflationary collapse. Fast forward to 2017, when you had this big collapse of the banking system, depositors were still safe. Anyone who was invested in a bank that the bank had an issue, they were still covered as a depositor. So we did not have a decrease in the broad money supply. We didn't really get a spike in money supply until these past couple years. So that's why we had two very different scenarios now. Lynette ends and says that if you look at the United States over the past 10 years, even with the low interest rate that you have got on your bank deposits, you have not kept up with official CPI, let alone what your personal inflation basket might have actually. So guys, here is the end of Lynette Talks. Now I would like to request you to please let me know your thoughts. Do you like this video or not? And on which topic should I make my next video? Till then, have fun.